You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp, the program for you out there. The very busy retail stock trader. Maybe you're thinking about dipping your toes into the options waters. Maybe you've already been slinging them one lots out there at some of those newer brokers, and you're trying to figure out what the heck is going on with these options things. Maybe you've done a few trades, got a little burned, and you want to figure out maybe how to improve your trading. Either way, we got you covered here on the old Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Remember, it's not just Bootcamp here, even though Education Wednesday is chock full. We got Bootcamp, got Options Playbook Radio coming at you a little bit later today, so you get a twofer of educational goodness on Education Wednesday. You get Option Block twice a week, Volatility Views every Friday, TWIFO this week in Futures Options every Thursday, interviews every Tuesday, and a whole bunch of other goodness scattered throughout the week there as well. So you know where to find it all. Wherever you're listening to this, make sure you upgrade to the full network. And, of course, leave those reviews so other folks can continue to discover and enjoy the program. More important than ever in these troubled times. And I'm pleased to say I'm also joined once again. He's back. He's rested. He's mostly digested from his big Turkey Day extravaganza. None other than the black-hatted one himself, Mr. Dan Passarelli, the founder over there at Market Taker Mentoring and the author of one or two or half a dozen options-oriented tomes. Mr. P, welcome back to Options Bootcamp. How was your big Turkey Day extravaganza, sir?
Hey, Senior Longo, good to be back. It was good. I just had my last bowl of turkey soup that I made. Yesterday was my last dish of turkey pot pie that I made, and we're all turkeyed out over here.
You know, it's fun. Everyone likes the big Thanksgiving extravaganza, but I think the leftovers are even more fun. Which camp do you fall in, sir? The big extravaganza or the leftovers? What's your favorite?
Dude, both. I love the whole pomp and circumstance. I love all the creative things that you can do with with the meal itself and everything afterwards. I love the whole thing, man.
You know what else I love, Mr. P? I love the fact that this episode brought to you by our friends over there at Demand Derivatives. What is Demand Derivatives? You might say, well, it's a startup futures exchange and clearinghouse. Yes, I said that right. A startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You guys already trade on exchanges. Now here is your chance to own one. Now, before they approach large strategic partners for funding, they're opening up a crowdfunding portal so that regular traders, just like you, have a chance to go out and buy shares. You guys, I'm sure, are familiar with crowdfunding portals. You probably kickstarted something in the past, maybe a cool electronic gizmo over there on Kickstarter or something like that. Here's your chance to do that now. But for an exchange, to my mind, this is the first time this has ever been done. It's pretty fascinating stuff. The folks at Demand Derivatives have a pretty deep bench They were early pioneers out there in the vol space, early supporters of our Volatility Views program a long time ago. This is a very fascinating campaign. In fact, I have participated in it myself. That's how interested I am in this. We're not just bringing you random stuff here. These are things that we think are very interesting for you. Where do you guys go to learn more? Well, you go to demandderivatives.com, DEMAND derivatives. Don't forget 2 D's there, just like market taker, 2 T's, 2 D's, demand derivatives in a row. Click on the crowdfunding portal there. You'll learn more. The minimums are pretty small, so you guys can get started, kick the tires, check out all the information there. They've already been pretty successful. I think they've raised about $100,000 already out there. So it's off rocking and rolling, but it's only got a few weeks left. So if you guys are interested, demandderivatives.com. Click on the crowdfunding portal. Just go to demandderivatives.com/crowdfunding. Interesting stuff. It's fascinating. It's certainly unique. I think you guys will find it very interesting as we head on into our basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Call in. Prepare to learn.
All right, everybody. That music can mean only one thing. It is basic training time. Usually the time where we break down some basic options, concept, or strategy, explain how you can utilize it in your own portfolio. Sometimes we dive a little bit deeper, sometimes to go into interesting other areas that impact your options trading, like what's going on in the underlying markets. And that certainly is top of mind, I know, for a lot of you out there. We're coming in on the end of the year now. Thank God, the end of the year that was 2020. I don't think anyone will be sad to put this one in the rear view mirror. But of course, it's been an interesting year from a market perspective as well. We saw the aggressive sell-off heading into the end of Q1, the almost as aggressive, if not more aggressive, rally and recovery that has taken place pretty much throughout the rest of the year. A lot of volatility coming back in towards the end of the year as you saw the election. Now that vol coming off again. So a lot of people are kind of scratching their heads and looking forward. We think, have a new administration. It seems like that's pretty certain coming in January. So that's going to shake up everything yet again. So there's a lot of things going on in the underlying market that are kind of interesting. And also, usually around this time of year, and a given year, we see a big rotation of various stocks. But now with the new administration coming in, that jacks that up to 11 as well. So, Dan, I know a lot of people, when they come to MTM, they have questions, not just about the options, but about what's going on the underlying side and how that impacts their options as well. So I know this quote-unquote great rotation, Dan, is a big topic of discussion for a lot of your mentees over there. So why don't you break it down for our audience, what's going on with this and why you think it's so important?
Well, it's really important because, I mean, look, there's a lot of traders who watch a show, but there's also a lot of investors, and most traders have an investment portfolio as well. And we need to consider what we should be invested in, right? 20 years ago, Eastman Kodak was probably a fantastic investment, but, maybe not quite as much anymore.
Wait, you're saying I should dump my Kodak stock? Oh, I'm sorry. I need to go.
Yeah, or just dust off the certificate and put it on the shelf next to your Polaroid camera.
It's framed on my wall, right? I'm looking at it right now.
Don't take my Kodachrome away, Mark. So when these shifts happen, that's the time to consider it. And we are right here on the heels. I mean, really, if we're just thinking about it for the first time, we'd be late to time to think about it because and really every time a new administration comes in, they focus on things that are different than the old administration. And so it's time to look at dumping some stocks that did well under the past one and buying some stocks that are likely to do well under the new one.
All right, so let's break that down a little bit. Obviously, like I said, we think we have a new administration. It seems like it's all a done deal. Nothing's obviously official until Inauguration Day, until the swearing in has taken place here. But it seems like we are headed in that direction. It also seems like markets are kind of liking what they're seeing, which is interesting because if you listened to our election night special, in the early blush, it seemed like markets were fading Biden and rallying on news that Trump seemed like he might be heading back to a second term. Then, of course, as the narrative shifted, as the momentum shifted towards Biden, the market shifted and decided they liked that too. And so they've been rallying pretty much ever since with a few brief pauses along the way. So, Dan, obviously, this big rotation is setting up. It's going on right now. What are you looking for? What are you keeping an eye on? What are some names and indeed some sectors you think will be dramatically impacted by this?
Well, the names are always tough, right? Because like here's the overriding philosophy. The overriding philosophy is, look, big picture, explaining it to a kindergartner, right? Like the government does two things. They borrow money or they take it from us in taxes, and they take it and I'll be generous and use the word invest, invest that money into different industries, in the form of tax credits or in the form of, just putting money into it or what. And one of the biggest promises of this next administration's, plan or whatever is clean energy, to get more off oil and more into clean energy. And so what do we look at? Do we look at Tesla? Do we look at Plug? Do we look at, at what? So I've been looking at the ETFs, and the iShares Trust Global Clean Energy ETF is one that's been really doing pretty well lately, sort of as a buildup from, back from in March, I guess it really started building up. It's definitely the definition of an uptrend. We've got higher highs and higher lows. We've had a pullback over the last 3 days or so for those of you who are listening to this live. And, then the question is, where does it go from here?
That is indeed the question, sir. One of the interesting things you're talking about ETFs, options on ETFs, they're not usually, first off, not all of them are optionable, listeners. So obviously we're talking about options here. So that's usually our preferred vehicle, our preferred point of entry. But sometimes not all of these things are optionable. And as Dan alluded to at the top of the show, we are talking not just to traders, but also to investors. So we will admit, begrudgingly on our part, but we will admit sometimes you guys like to sling a little bit of the old underlying as well. Dan, when you're out there approaching some of these ETFs out there, A, are you screening for ones that are primarily optionable? Is that your primary go-to? And then B, I know sometimes it's an issue with liquidity in some of these names that are optionable. There isn't a heck of a lot of volume going up in the options. So do you have any concerns about trading options on some of these ETFs that may indeed be less liquid, sir?
Yeah, very much. I mean, like you, I'm an options guy, right? So I always want to look for stuff that's optionable. And yeah, it's really, really essential that the bid-ask spreads are tight enough. Now, like in an investing portfolio, am I going to go in and buy, 100 calls or something like that? No, probably not. Because when you're investing with options, you're kind of using them as a proxy for the underlying, or to hedge the underlying, or to generate income on the underlying. So we're talking about 1 lots, 2 lots, 5 lots, maybe 10 lots tops. And so we're not needing crazy open interest, but we do need tight bid-ask spreads, because I've been looking at a really, really textbook strategy here. Super textbook strategy on how to use options to invest in ICLN.
Let's get into that then. Let's talk about how to use the options to approach these things. We talked about it in the past, listeners, using options as a proxy for the underlying. We're not talking about swinging for the fences, buying your 1 lot on your 5 delta calls on Apple or Tesla or whatever else we know a lot of you are out there doing right now. Something with a little bit better profit probability, chance to actually make you some money and also not lose you a boatload in the process. So, Dan, we're out here looking at different names, we think, in different sectors that are going to benefit from this rotation. When you identify this, like you mentioned a green name, for example, when you identify these, what's your preferred go-to? Are we talking, in the money, more of like a stock substitution type of play? Are you talking maybe verticals or out of the money? What is your preferred go-to for playing these, sir?
I just like the pretty close to the money calls. And so if you look at ICLN, it just hit an all-time high 3 days ago. Again, for those of you who are listening live, what is today? December 2nd, right? And so, is the big move priced in here? I mean, it's up, oh, geez Louise. I mean, it's up like, it looks like almost 100% or something from the beginning of the year. So is the move priced in? I think probably not, but you never know. It's a pretty big move. So simple textbook strategy, just buying some calls that expire in a month or two totally at the money, and doing that with the plan to literally let those get automatically exercised if they're in the money. And if they're out of the money, hey man, no harm, no foul. You're out a couple of cents a share instead of, getting caught up in a big 10 or 20% pullback from the big run up. So totally textbook strategy. And I can get into some of the details if you want here too, get into some numbers.
Yeah, let's get into some of the details. I think that's interesting for people. And also, like Dan mentioned, this is a pretty straightforward approach. We're not talking very, very sophisticated strategies here. We're not talking about ratio, iron fly swaps or anything along those lines. Like you mentioned, just straight up at the money calls. Also nice because, as we mentioned before, obviously buying a call, a much more limited risk profile than owning the underlying. Because looking at this chart, as Dan mentioned, at the beginning of the year, it was trading $11.01. And as of right now, it is trading $23.11. So it's had a nice move. It's had a nice pop. There is a potential that it could retrace on some of that. And you don't want to be holding the bag all the way back down to, let's say, 15 or something like that. So calls give you a little bit more limited exposure to that downside. So, Mr. P, you're talking about trading the old standby of the at-the-money call, sir. Walk us through it.
Yeah, so, just bear in mind, just to predicate this, bear in mind that like a long call synthetically is a married put. Like it's like buying the underlying and buying a put, but you're tying up less capital. You're just doing it cleaner and easier. So right now, as I'm looking at this, as we're recording this, ICLN's at 23.10. And so, I would like to participate in the upside, but protect myself for the downside. So I can buy the December 18th, 23 calls, or I can buy the January 15th, 23 calls. I actually did already buy some of the December ones, but let's look at the January ones for sake of argument. If I were to buy the January 15th, 23 strike calls, the at-the-money ones, I can buy them for $1.40. Now, we've talked a lot on the show about using a volatility analysis to know, hey, am I overpaying for these options? Am I getting a good deal on them? Am I selling them high, selling them low? We always want to do a volatility analysis. And I did the volatility analysis, and I'm here to tell you these options are actually slightly overpriced. So on the surface, and from a lot of the things we've talked about when it comes to trading options, it seems like maybe a silly thing to consider buying these here. But big picture, look, I wouldn't be buying this ETF to hope that it, gains 10% over the next year. Like, I'm looking at this as a potentially pretty powerful play, over the next 4 years. So I don't really care if I slightly overpay for volatility in this case. I'm just looking at it as hey, worst case scenario, I lose $1.40. My break even ends up being $24.40. Big freaking deal. Like, I don't anticipate it getting just up to $24.40. I anticipate it getting up to, 27, 28, 30, 40, 50 maybe. I don't know. Over the next 4 years, I wouldn't be surprised if it can double or something. So it's a really simple, elegant play. Like the stuff that you read in textbooks that usually on our show, we're like, yeah, that's the textbook stuff. Here's how it really works. But when you're using it to get into a long-term investment, this really super simple textbook play works great, man. Works really great.
Yeah, that's a good point about holding those, through expiration. Usually we don't counsel that. Usually that's not really our go-to. Usually it's put them on, take them off, move on to the next thing. Unless, of course, you're selling puts. We usually advocate there that you pick a strike that you're comfortable picking up the underlying. I know a lot of you say you're comfortable. You usually balk when it's time to actually get the underlying. In fact, I think we have a listener question about all that goodness a little bit later. But still, it's something interesting and not something we often talk about here on the show, actually riding that pony all the way through the gate there, through expiration. So, Dan, we got your new name that you're watching out there, good old ICLN, a.k.a. the iShares Global Clean Energy ETF. We got one of your plays on the Great Rotation. Any other nuggets you want to share with us on the Great Rotation before we squeeze in some of the listeners, sir?
I figure focusing this show on just the political aspect of the Great Rotation. There's also the COVID recovery aspect of it. But you want to save that for another show, or you want to jump into that here?
We're talking rotation. We might as well do it all now, sir.
Yeah, okay.
Let's spin all the way around while we're at it.
Yeah, so that's why I call this the Great Rotation, because there's a whole bunch of rotation potentially going on here. The other one that's been kind of it's like when you're playing street hockey and a car goes by and you're like, oh, wait, time out, game off, hold on. Okay, the car goes by. Okay, game on. That's kind of what's going on with this other rotation, a sector rotation. And so what we typically see when we have a market crash, or a bad recession or something, when the market really, really pulls back and interest rates get cut, is people go into growth stocks, which includes especially technology stocks. And, that's kind of obvious when you think about why, because these are companies that have room to grow. And if you can borrow money at a zero interest rate, it just makes it so easy to do that, And so, anybody who's been long Apple, Amazon, a lot of tech companies, Zoom, some of those have implications because of the pandemic, of course, too. But it's just it's been a great time for tech stocks because interest rates are so low. But what you typically see is when markets start to recover, you see, okay, let's sell out of those growth stocks that already had a big run up, and let's buy what we call cyclicals, which, I don't know, the way I like to describe cyclicals are regular old companies that sell stuff that you need, or sell stuff that companies who make the stuff that you need do, like industrials and tractors and gym shoes and clothes and, and all that. And so, that's another rotation that I'm looking at, just kind of throwing that out really, really big picture. I don't know if I don't really necessarily feel a need to get into real specific names or anything, but that's been a little bit hot and cold, every time things kind of start seeming like they're better economically and the pandemic's looking like it might be in the rear view mirror, we see that transition happening a lot more. And then we're hearing, the numbers are getting worse, blah, blah, blah. Then we see, people say, oh, no, we're going to go get back into growth stocks, and they start rallying again.
What's never hot and cold, Dan, are our listeners. So let's get to them, a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. I alluded to that question about expiration. I'm not sure if we're going to have time for that one on today. He also has a good question about the Mandalorian. We'll have to get to that in the next episode. I'm dying to get into that one, but we'll get into that in the next episode. Instead, I think we have time for this one. This comes from Leon Teller. He wants to know, how did Chicago become the Mecca for options trading? Why not good old New York City? Well, yeah, people think of New York City as the financial center, and it certainly is, particularly for stocks and fixed income and those types of things. But for what we're talking about here, ye old options and indeed derivatives, it's right here in Chicago. And you're right, that might be surprising to some people. How did that evolve? Well, of course, Chicago has quite the storied history of exchanges going back to the old butter and egg days and everything else that eventually transformed into the Board of Trade here in Chicago and, of course, CME, the Chicago Mercantile Exchange. They are now, of course, one entity. So CME pretty much owns the Board of Trade, so all that stuff's under one umbrella. But before they did that, way back in the dark days of, 1973, that's when the Board of Trade spun off the Chicago Board Options Exchange. That's why there's a board stuck in there. People are always confused. Why is it, the CBOT and then the CBO spun off of the Board of Trade? That's kind of how that whole thing started. And that was specifically to focus on options. Obviously, futures were already trading here. They were created here in Chicago. Well, technically, they're created by the Knights Templar back in 1200, but we won't get into that. The modern incarnation of financial futures were created here in Chicago, and that started trading, of course, on the Board of Trade and the CME. And so when it came time to consider options, they spun it off on the Board of Trade and made that very focused entity of the CBOE, which became, of course, the only options exchange. Over time, other venues started adding options. When I came out to Chicago in 1997, start trading on the CBOE, there were other places you could trade. I did evaluate them. They were trading some heating oil options in New York. Over on the Amex, you could trade Intel options. The P-Coast out there in San Fran had a few of the tech names listed out there. So there were some other options trading in other areas. The Philly was out there, of course, trading some options there. But the Mecca was really here for the options. And that's kind of how it developed here. And then, of course, it sprung into multiple listing in 1999 that every exchange could trade everything. But you know what? The legacy, the momentum was all here in Chicago. And this is where the deepest pool of liquidity was and still is. This is where guys like Dan and myself came here. Well, Dan was born nearby. I traveled like a lot of people did from hither and yon to come trade and learn about these there options things in the pits. And it has remained that way to this day, even though we are rapidly approaching that fabled day I've talked about many times, where you could effectively run a liquidity providing firm or indeed a hedge fund from a beach on your smartphone these days. We're pretty close to that day. Not quite there yet on the market making side, but pretty close. So maybe the days of the pool of liquidity being centered around Chicago, maybe they're numbered. But for now, at least, that is still why Chicago is the Mecca. Mr. Dan, anything you want to add to the sordid tale of how Chicago became the Mecca for options trading, sir?
Yeah, man, I am a total nerd for this stuff. So, like, even to go back a little bit further from where your story started, let's just call it the prequel, if you will. Let's not forget that.
Hopefully it's better than the Star Wars prequels, sir.
Yeah, right. Let's not forget, Chicago is on Lake Michigan here, right? And far enough south where, it's a really perfect hub for people to bring their grain and their livestock. But it became a really good place to bring grain and livestock because up in Canada, a whole long time ago, I forget the date, but it's a whole long time ago, they dug out a canal called the La Chine Canal, I believe it's called, which made it possible for the St. Lawrence River to become a waterway to ship stuff out from the Great Lakes out to, all over the world and such. And so that enabled, digging out that canal enabled Chicago to become this hub for grain and stuff. And so everybody's bringing their grain, bringing their livestock. And so it just became a really natural place for people to make deals to take future possession of these things, and, that started with forward contracts that then became futures contracts. And then we get into Mark's trilogy.
Yes, the good trilogy, the trilogy everybody came for, as opposed to your prequels with midichlorians and all that other stuff out there. All right, listeners, unfortunately, or perhaps fortunately if you're not a fan of the prequels, I guess the prequels have some redeeming factors, but not a ton. That music means we've come to the end of this episode of Options Bootcamp. A pro tip: if you join us live and we record these on Wednesdays, usually around 2 p.m. Central, started a little bit earlier today, but usually around 2 p.m. Central is usually when you can find us here on the old Mixlers. If you join us live, you get the second episode in your ear holes instantaneously. Otherwise, you got to wait a whole darn week. But Mr. P, while they're busy waiting, maybe they want to learn a little bit about options. Where should they go? What should they do?
Yeah, make your way over to my website, markettaker.com, 2 T's in a row. And we've got a ton of free resources there. Go get a free membership. We've got some, complimentary classes if you're just getting started. Even some that are a little bit more advanced. You can join our chat room for free. And you can contact us there, too, if you have some specific questions.
There you go. Market Taker Mentoring is the place to go. Don't forget the second T there. And while you're going places, and while you're thinking about joining things, have you ever thought about joining perhaps a crowdfunding campaign for something cool, like perhaps an innovative new startup futures exchange and clearinghouse? Well, if you have, then you got the place to go. Demand Derivatives. Yes, this episode brought to you by the folks over there at Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You guys already trade on an exchange. Now is your chance to actually own one. Before they approach large strategic partners for funding, they have set up a crowdfunding portal so that regular traders, just like you, have a chance to buy shares as well. You know where to go, demandderivatives2ds.com. Click on the crowdfunding portal for more info. And on behalf of Dan and our friends over there at Demand Derivatives, and indeed myself, I thank all of you out there for downloading, streaming, and subscribing. Also for sending in so many questions. Don't worry, we'll get to them immediately if you're listening live. Otherwise, on our next episode, and we'll see you back here right again next week for another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.